Shifting focus to the bond and currency markets. Now, global markets are on edge following the Federal Reserve's latest interest rate hold and ongoing government shutdown talks. And here at home, strong gold prices and optimism around a US and SA trade deal are boosting the rand. And joining me in studio to unpack what's moving the bond and currency markets is James Turp from Sanlam Investments. I must actually correct myself. There was not a hold from the Fed. It was a cut.
Correct.
We had a hold.
That's right.
All right. I mean, I just want to start off with how the rand and the bond markets have been reacting, their behavior of late, and just the level of optimism that is filtering through here. It's not something that we expected, was it?
Zanati, thanks for having me firstly, and that's an excellent way to start any interview, on a positive tone, because it's really been, we've had currency strength, we've had bond market strength, we've had platinum up, you spoke about commodities, gold up. I mean, this year has been perfect. It didn't start that way though, did it?
It did not.
It was tariff, and President Trump and uncertainty and all these concerns. Then we get through it and almost everything has gone perfectly since.
Yeah.
We've had foreign investors piling into our bond markets. We've had the rand, at least against the dollar, strengthening, which adds to the stable outlook. And then on top of it, we had the Reserve Bank confirm, firstly hinting quite strongly, and then confirming that they will target lower inflation. So it's been a massive year and bonds have performed amazingly well as a result.
It's actually interesting because you talk about the rand strengthening against the US dollar, maybe not so clear on all the other currencies. So really speaking to a dollar story here, that the risk that does surround the US is benefiting us?
Yeah. So it's part of their foreign policy that they wanted to go with these increased tariffs.
Yeah.
And that's going to add debt. And then they're going to cut taxes to try and make up for that with economic growth. But they want to target, it seems, a weaker dollar, which then, weaker dollar, of course, benefits your export market. And that makes you more competitive as a result. So it's part of their strategy. And we've seen the rand then, as a result, strengthen against the dollar. But you're quite right, on a trade-weighted basis, the rand hasn't necessarily moved that much. So other currencies also strengthening against the dollar as well. So the central bank does look at it on a trade-weighted basis, but we're always monitoring our position against the dollar. I guess that's just how global currencies are priced generally.
Yeah, it's quite interesting because a lot of the time, the big influence, I mean, even now we are seeing is global factors, but also you mentioned domestically as well, our own kind of monetary policy stance at this point with the Reserve Bank targeting that 3% target. But also with that, I mean, we've seen with that desire for that 3% target, now monetary policy kind of shifts to maybe less dovish than most of us would like it. What impact then does that have on our currency and bond market? Does it just have a one-way impact, or could this be a double-edged sword?
There's always a double-edged sword in financial markets. It's a good way to position it. So short term, you have almost a sacrifice. They call it a sacrifice ratio, because you're going to keep interest rates slightly higher than you would have, because you want to get inflation lower, so you want to facilitate that with higher interest rates. As a result, short term, you'll have a growth impact as the economy isn't stimulated as much. But the view is, and the central bank's view is, ultimately it leads to lower and more consistently low interest rates, which benefits South Africans then as a result. So that's the position they take on it. Now, the downside of all of this is it hinges a lot on the central bank's credibility, on the central bank's ability to have gotten inflation from where it had previously been around 6% and higher to an average of around 4.5% for the last 10 or so years, or maybe less since about 2017 when they actually targeted it, 8 years. And now to get it to 3%. Now they've got the benefit of it being around 3% already when this was announced. So we know, and it undershot to 3.3 recently when we were expecting 3.5. So the risk is, though, that it suddenly, for reasons that we can't control, starts moving higher. Maybe it's administered prices, which the Reserve Bank Governor Kganyago flagged as a crisis at the moment. Higher administered prices, electricity rates, all these sorts of things that are out of control. Maybe currency weakness for a reason we can't control either. Oil perhaps goes out of control, things like that. And suddenly inflation starts moving in a way that higher interest rates can't contain. It's not our base case at the moment, though, because there's very little going on in the economy. So most analysts we're seeing are moderating their forecast lower in line with this, and that you kind of question them tongue-in-cheek and say, oh, okay, so why wasn't it always like that? And it's the strong influence of expectation. So if you're expecting a credible reserve bank to get inflation to 3%, then it should be so. So we're seeing those forecasts moderate as such, but the risk, as you say, is that something happens and it changes the outlook, and then those expectations change. That then requires higher interest rates, and that affects economic growth, and that undoes a lot of the benefits that we want, or it delays those benefits even longer.
Yeah, I guess maybe at this point, the base case is, as you mentioned, short-term pain for longer-term gain. But now, obviously, what you get with that short-term pain is on the economy, economic growth. Maybe not a lot of consumption because interest rates are still higher. And I'm wondering then, does that shift the ball to the court of fiscal and economic policy to prop up the economy?
Quite right. It's something that even the Reserve Bank talks about. There's only so much they can do. They've got to look at price stability and keeping investors happy with the rand not weakening, and they're getting that right. But the structural reforms, those measures that can facilitate economic growth and most importantly get unemployment levels down. We've got the highest and most dangerous levels of unemployment in the world in some cases. And yes, there's a huge informal sector. It's hard to completely calculate our unemployment, but it sticks out relative to other emerging markets as being unacceptably high. So reforms from government to address that and address that quickly would be best set to get economic growth up. Interest rates do a small amount of the lifting, but the real heavy lifting comes from Treasury and government policy. One
last question, and I know this, I ask this to everybody that I talk to. The rand, because we always want to know where the rand is going to end up. And I know that nobody has a crystal ball, but just looking at how things are going now, where could the rand go by year end? I think we're about, 3 months away from year end. And really, just where you're seeing fair value for the currency at the moment.
So that's the most difficult question. It's kind of, so my usual answer before this year has been, I would bet on it being a little bit weaker because we've always had higher inflation than the US. And so currencies tend to depreciate in a line that's equivalent over time of that inflation differential. Now, though, we're seeing our inflation levels targeted lower to 3%. So the US target 2%. So we'd still expect weakness over time against the dollar. But now that we're in this sweet spot of US policy wanting a weaker dollar, we're targeting lower inflation by keeping interest rates a little bit higher for longer, high real rates. We think we can see the rand a little stronger from here still into year end. It's just as you said in the opening, around 1730. We would think it can get as low as 16.5 perhaps by year end, but a brave person would put their name against a forecast on a date like year end. Not for me, but I think the trend will be stronger.
All right. Well, James, thank you so much for your time and for your insights today. Really, really appreciate just your giving us more detail on this very, very important landscape. That was James Turp from Sanlam Investments.